Well, hey there. It's Thursday, so that means it's time for 3 Minute Thursday. I'm Terry Sawchuk from Sawchuk Wealth. So a lot has changed in the last week as it relates to the markets and interest rates. And some of this has to do with we're kind of in this phase now where it's bad news is good news. And you can see in the interest rate markets here, this is the United States 10-year Treasury. And not that long ago, it was all the way up at 5%, but more recently, okay, it was up at 4.7. This is back April 24th. So here we are, a month and a half later, and now the 10-year Treasury is at 4.293%. And that's kind of inversely related to the stock market. And the reason that the 10-year Treasury has dropped the way that it has is because we had some economic data that was soft. First of all, earlier this week, shockingly, GDP was revised downward all the way to 1.6% from over 3.5%. And this is just typical from this administration. The information comes out, sounds rosy, everything's great. All the fanfare around how good everything is comes out, the market responds positively, and then quietly a couple months later, they revise everything downward to where it actually was and where the experts thought it was going to be. So it's not surprising, this is just how they do things. And incidentally, though, I guess from a positive standpoint, if you're an investor, if you look at the S&P 500, you can see that we're in this range and it's going up, right? So that's good. The S&P is at 5350 now, which is quite a bit higher than it was just at 4965 again back in April. And it's no coincidence where rates peaked right around this time, so rates have come down and the stock market's gone up. And I think this trend will continue, again, because we're kind of in a bad news is good news. Unemployment is increasing a little bit. Some of the leading indicators have softened a little bit. And this is all important because in the end, the market is front-running what it thinks the Federal Reserve is going to do. And so now we're back to pricing in at least two rate cuts this year. And I would say, 2 weeks ago, we probably were at 0 rate cuts. But with the softening of the data and inflation seemingly softening a little bit, remember, inflation is not decreasing, it's just increasing at a slower rate. So we're still dealing with inflationary pressures, which, by the way, are way above 2%, probably above 3%. So well above the Fed's target. But at this point, it's pretty clear that the Fed and Treasury are going to be supportive of economic growth or economic activity and the stock market growth until the election is come and gone. So for now, it looks like we're kind of in a bullish trend. It's a short-term trend. I don't think this is going to last too long, but certainly between now and the election, the direction is likely going to be more up than down. And so you have to have some equity exposure right now. I wouldn't say, go crazy with equity exposure, but I think you have to have some. And as we get a little further along, we might start to pare it back. But for now, the bulls are in charge.